Have you ever felt like your money just doesn't stretch as far as it used to? Ever wonder if there's a single number that actually explains why? Well, guess what? There is. And today, we're going to pull back the curtain on what that number is and why it's one of the most important figures in the entire global economy.
I mean, we all ask ourselves this, right? Whether you're at the grocery store, paying rent, or filling up the car, you're constantly making this mental comparison. It's just this universal feeling that things are different.
And it turns out there's an official economic tool designed to answer that exact question. It's called the Consumer Price Index, or the CPI for short. You can think of it as the economy's ultimate price tag.
So what is the CPI really? Well, officially, it's a measure of the average price change for a whole bunch of stuff we all buy on a regular basis. This makes it the absolute go-to number for tracking a word we hear all the time: inflation.
Okay, so you might be thinking, how on earth do they boil down the entire economy into just one number? And the answer is actually a lot simpler and more intuitive than you'd think. It all starts with a shopping basket. Just imagine a giant, imaginary shopping basket that's filled with everything an average family buys. We're talking about the essentials, like bread and milk, sure, but also your rent, your electricity bill, transportation, and even things like clothes, internet plans, and movie tickets. The CPI just tracks the total cost of this exact same basket, month after month, year after year. Now, here's where it gets really clever. Not everything in that basket is treated equally. Just look at this. Items are weighted based on how much of our budget they take up. Housing is the big one, the absolute giant, at around 40%. So what does that mean? It means a 10% jump in rent has a huge impact on the final CPI number, way, way more than a 10% increase in the price of movie tickets. The key thing to remember is some prices just carry more weight.
The calculation itself is a pretty straightforward three-step process. First, statisticians pick a base year, and they just decide the CPI for that year is 100. It's a starting line. Then they meticulously track the price changes of everything in the basket. And finally, they apply those weights we just talked about to get the new CPI number. So if the CPI today is 112, it just means things are 12% more expensive than they were back in that base year. Simple as that. So let's zoom out a bit. Let's see how this simple calculation becomes this critical tool for governments and central banks all over the world. This number doesn't just sit in a report. It actively drives massive economic decisions. Now, when you hear about CPI in the news, you might actually hear two different terms. Headline CPI includes absolutely everything in the basket. But because food and energy prices can go wild from month to month, economists also look very closely at core CPI, which takes them out. This gives them a much clearer picture of the underlying long-term inflation trend, and it's why central bankers are often obsessed with that core number. So how do these two famous terms, CPI and inflation, actually connect? It's really simple. The CPI is the tool, and inflation is the result. Think of the CPI as the thermometer for the economy. The inflation rate, that's just the change in the temperature reading from one period to the next. Let's look at a super quick example. Let's say the CPI value in 2024 was 108. That just means prices were 8% higher than in our base year. And by 2025, that value had climbed all the way to 114. So how do we get the inflation rate from that? And boom, it's 5.55%. You just take the change between the 2 years, divide it by the starting number, and that's it. That is the number. That is the annual inflation rate you hear about in the headlines, the one that can send markets either soaring or tumbling down. And why does that one number matter so much? Because huge institutions like the US Federal Reserve use it as their main guide. If CPI is shooting up too fast, they'll almost certainly raise interest rates to cool the economy down. If it's too low, they might cut rates to try and get people spending again. It's all about trying to keep the economy stable and ultimately protecting the value of the money in your pocket. Okay, that's the big picture, government-level stuff. But let's bring this right back down to earth, because this number has a direct impact on your personal finances every single day. A rising CPI is exactly what you feel when your grocery bill is suddenly higher, or when your landlord tells you the rent is going up. On the flip side, many salaries and pension payments are actually adjusted based on the CPI to help you keep up. That's what a cost of living adjustment is. And when the central bank raises interest rates because of a high CPI, well, that could mean your mortgage and loan payments are about to get more expensive. It's all connected. Okay, so we've seen how CPI affects your wallet over time. But what happens in the crazy, high-speed world of finance? Let's switch gears for a second, because when this number drops, the reaction is anything but slow. And I mean that literally. The moment the monthly CPI data is released, trading algorithms and investors all around the world react in a fraction of a second. We're talking about billions of dollars moving based on whether that number is just a tiny bit higher or lower than what everyone was expecting. And the reaction is different depending on where you look. A surprisingly high CPI number can actually make a country's currency stronger because traders start betting on higher interest rates. But that same number can be really bad news for growth stocks, which often rely on cheap borrowing to expand. And in the crypto world, well, sometimes a high inflation number can send investors flocking to assets like Bitcoin, seeing it as a potential hedge, a way to protect their money from losing its value. But as powerful as the CPI is, we have to be honest, it isn't perfect. For one, your personal shopping basket might look totally different from the average one. It can also struggle to account for improvements in quality. I mean, your new phone is more expensive, sure, but it's also 1,000 times better than your old one. And in many countries, it can have a bit of an urban bias, not quite capturing the real cost of living out in rural areas. So, to wrap this all up, what's the one thing you should take away from all this? Just remember this. The CPI isn't just some dry, boring statistic. It is the official measure of our changing cost of living, and it truly is the heartbeat that dictates the rhythm of inflation, interest rates, and the financial markets that we all depend on.